Hello and welcome everybody to the channel. On here, I like to discuss my passion for investing by talking about stocks, analyzing businesses, and learning lessons from the greats like Warren Buffett. This is a community for investors that like to keep it simple. We buy great businesses and ideally we like to hold them forever. We don't worry about day-to-day price fluctuations on this channel, but we do like periods when the market is down because that drags good businesses along with it and provides us an opportunity to buy those businesses at a lovely discount. And I'll tell you right now, everything is at a lovely discount. We also do our best to try to understand the economics of the business and what that future may look like. Today, we're discussing possibly the best business on the planet, Microsoft. A true tech juggernaut. They are the second largest company in the world, right behind Apple. My investment thesis for Microsoft is very simple. So without further ado, let's get right into it. Please, if you haven't already, hit that subscribe button and please like this video. It really helps out the channel, that helps us grow, and lets me know you want to be a part of this community of quality investors. All right, so we're here on my investment summary tab. And before I get into all these little metrics, I do want to talk quickly about Microsoft. So they are on the leading edge of AI development with OpenAI, ChatGPT. They've incorporated it into almost every aspect of their ecosystem, like Bing, Microsoft Edge, Windows Copilot, the Office Suite, cloud services, and just so much more. They're just such a innovative company in that regard. Their moat is very strong. They have a lot of subscription-based revenue, which is something I really do love. They have Office 365, Xbox Game Pass. They own LinkedIn, GitHub, OneDrive storage, cloud services, and just a lot more. And that's such a diverse product offering. So they have a lot of ways to generate that revenue. Also, Windows is essentially the default PC operating system. Who doesn't love that? That really creates that strong moat for them. And with that, it creates very high switching costs. If a corporate office, for example, installs all the Microsoft products, it's going to cost that business a lot to deviate away from it. So they really lock in customers with their product offerings. And on top of that, they also have a very high network effect just because of how integrated their applications are. I mean, a developer never has to leave the Microsoft ecosystem. You know, GitHub, Visual Studio, SharePoint, Power Apps. And if you're ever using that stuff, you know it's all very easy to use. And I'll tell you from experience, I did some consulting work at Microsoft a few years ago, and let me tell you, that company is just, it's full of very smart people. I really enjoyed the project I worked on there. It's very engaging. And on top of all that stuff, they reward shareholders with share buybacks. Right now, they're in the midst of a $60 billion buyback program that currently has 22.3 billion, I should say, left on that program. And in their revenue stream, I do like the revenue stream. If we can take a quick look at it here, they have the intelligent cloud, productivity and business processes, more personal computing. The intelligent cloud has things like Azure, Dynamics 365, their server and cloud services. Productivity of businesses were like Office 365, LinkedIn, and then of course the personal computing, like devices. The Surface, and then of course the Xbox and Windows operating system. And you can see here, they generate quite a bit of gross profit, 68% gross profit margin, which is excellent. And ultimately, that comes into earnings of nearly 50% earnings there, which is just incredible. We look at some of the results of the segment operations themselves, and we see that both their productivity and business processes and intelligent cloud, they've grown quite a bit. 9% for productivity, 17% for intelligent cloud. The more personal computing is down, however, 10% from the prior year. Now, I will say with that, it seems to be an industry-wide thing. A lot of tech companies right now are struggling with their physical product offerings. Seems to be down. That could be because of the economy. I'm not going to give an intelligent reason why, because I just don't know. But we should see a lot of that turn around, hopefully, going into 2024. Microsoft also does a lot of acquisitions. We talked briefly about the OpenAI acquisition, but they're also on the verge of closing their Activision deal, which is a pretty big deal for their gaming services. I like the kind of acquisitions Microsoft does, because they seem to be very integrated, or well integrated into their entire ecosystem of product offerings. Okay, so back onto our investment summary tab here. So we come in here and we see that right now they are trading at a price of $312.14, down quite a bit from their highs earlier this year of around, what was it, 360, something like that. And they've been in quite a decline. You can see in the last month they've fallen about 3.36%, and they're down 5% in the last 3 months. And because of that, they're on the dip. And I think it could be a very good opportunity to buy some shares of Microsoft right now. So if we look at their PE, it is a tad bit high. You know, I think it's actually pretty average for them. They have it's a 32.2, which is slightly below their 5-year, slightly above their 10-year average. Like I mentioned, that gross profit margin is excellent, nearly 70% of a gross profit margin, above their 5 and 10-year averages. And one of my favorite metrics, return on invested capital, 25%. It is a little bit below their 5-year average, but all around just an excellent return on invested capital. It just really shows the strength of that management team, and especially their CEO, Satya Nadella, who I'm very bullish on. I think he's a visionary leading the helm there. Looking quickly at their dividend metrics here, they have their last year they paid out a total dividend of $2.72 a share. They did just bump that last week 10%, which Microsoft seems to do. They seem to just bump that dividend every year by 10%, which is excellent. And now it's at $3 a share. So anyone that holds shares for through their fiscal year 2024 have a nice $3 per share dividend. And they have an excellent free cash flow payout ratio at 34.15%. Coming up here, we can look at their revenue per share growth. All these are going to be their 10-year compound annual growth rates. Almost 12% per revenue per share growth. The gross margins, I would say, is pretty stable. They have lowered their OPEX margins, and they've grown their EPS quite nicely at nearly 15% over the last 10 years. Like I mentioned, that share buyback program, excellent here. And again, 10% like clockwork dividend growth every single year. They've also grown their free cash flow per share at over 10%. Just all around, just such a very strong, healthy company. And this is all stuff I really like to see. I do have a scoring system here. I will get into this a little bit later, and I can detail it in another video. However, you can see that their growth scores come out to about 2.95. And, you know, I like to see a little bit above a 3, but Microsoft is a very mature company, so they're not going to be growing like that 15% like they used to. And their dividend score is also a little low. However, that's just due to the yield itself, more or less. You know, I mean, with their share price trading as high as it is, of course, that dividend yield is going to be a little bit low. But we can see they have a excellent economic moat, like I did briefly discuss earlier. Just all the metrics that I think pertain to an economic moat here, with gross margin average over the last 5 years, CapEx as a percent of net income, how their ability to convert free cash flow, you know, the SG&A margin over the last 5 years. These are 5-year averages. And of course, like I said, my favorite metric, return on invested capital, and then return on capital employed, all very strong. This is a 1 out of 5 scoring system. And then quickly coming over here, we can see since Mr. Nadella took over as CEO just about 10 years ago, we can see that just great share growth here. And of course, you know, the history is not an indicator of future returns, but I do very much expect Microsoft to continue, precisely because they're on the leading edge of AI. So just excellent returns, and just it's a really great company to just park your money and let it grow. So to me, we come over to the charts here, and for me, it's just like a work of art. Like everything's just perfectly growing exactly how you want to see it. You know, their SG&A margin coming down beautifully, operating margin increasing, the shares coming down. For me, this is just excellent charts here, and I love seeing this out of the companies that I invest in. Looking quickly at their per share amounts here, we see that revenue per share growing like clockwork, and that free cash flow per share growing quite nicely as well. It has dipped a bit in this past prior fiscal year. Again, I think that's a lot of malaise in the economy. It's just driving a lot of these companies in the tech industry down a little bit. But you can also see just creeping up of all their ratios, which you're going to expect from a company that just trades at such a premium as Microsoft does. All right, so now we get into the meat of the valuation here. Projecting the growth rates, always an art form. So for this fiscal year, June 24, I'm projecting a 10% year-over-year revenue change here, 32% margin for net income, which is fairly in line with their prior 8 quarters here, you can see. And of course, earnings per share growing just about 13%. All of them, I think, are in line with historical averages. And honestly, I think it's going to be more. I'm trying to be conservative here, but really I'm very bullish on not only Microsoft, but just what they're doing with their AI and their product offerings in general, how they're pushing so many people into their cloud and subscription-based revenue services. I just think that they have a lot of potential to grow even more. So on a going forward basis here, we have year 1 through 10 revenue growth. So I'm projecting about a 9.56 compound annual growth rate for revenue over the next 10 years. And for net income, about a 9.33% CAGR. And with earnings per share, it's a 10.75% CAGR. So the way I derive our net income here is I estimate a multiplier. Basically, I estimate net income to grow about 95% of what the earnings per share grows. And that's really based on what I see up here through their 1, 3, 5, and 10-year history. So you can see that that's pretty much what the historical norm is. And then for free cash flow, I estimate the free cash flow conversion, how their ability to convert net income into free cash flow. And I'm estimating that at about 90 cents on the dollar, which gives us a free cash flow compound annual growth rate of 10.33%. Very nice growth rate, maybe a bit above their 10-year average, but like I said, I'm very bullish on the company. And if we do look at the free cash flow margins based on that, it is pretty in line with what their historical margins are in free cash flow. So I'm not too worried about that growth rate there. Okay, so let's see what all these growth rates do and what kind of valuation they spit out for us. Let's go over to our discounted cash flow tab. Okay, so our projections, they come in down here on the free cash flow. We're projecting year-over-year growth, 15, 7, 10, so on. Like I said, 10% compound annual growth rate. That gives us our present value of free cash flow down here and our exit value right here. And I'm using an 8% discount rate. I typically use 8% discount rates for all of my valuations with a 3% perpetual growth rate into the future. And that gives us an intrinsic value of $2.2 trillion with about 7.5 billion shares outstanding. That is a dollar cost or a discounted cash flow price of $302.58. Coming over to our dividend discount. Okay, so like I mentioned earlier, Microsoft, like you can just set your watch to it, they pay that 10% increase of their dividend every single year. So in my view, it's very easy to project that. Their free cash flow payout ratio is so low that I'm not worried about them being able to cover that in the future. And this is the way this company generates free cash anyway. So like I said, I'm putting in 10% per year on their free cash flow growth. And I'm very comfortable putting in a 7.5 dividend growth rate in perpetuity there, which gives us a dividend discount model price of $607.88. For our exit multiples, peer comparison, I have selected Adobe, Fortinet, which is a cybersecurity company, Apple, and Oracle as my comps. And the average PE of these comes out to 37.64, which is a little bit above what Microsoft's current PE is right now. And that gives us a exit multiple price of $364.77. All right, and with that, the big reveal. What is the final valuation? Okay, so come back over to the investment summary tab. You see I had these boxes blacked out. All right, we remove the discounted cash flow, $302. We are including our dividend, $607.88, an exit multiple price of $364.77. I am not including Graham's valuation because that is more for a company that is low growth, like less than 7% a year kind of thing. Okay, so our final valuation average comes to $351.77. That is a potential upside of nearly 13%. So very nice growth there with a 10% margin of safety. That gives us a buy price of $316.59 and a recommendation of buy based on that current share price of $312.14. If we wanted to use a 20% margin of safety, we can see what that price comes to. You can wait a little bit, maybe down to the $280 to $290 range. It's very likely that the next couple of weeks here, with the massive tech sell-off that's going on, that it can come down to that price. However, what I would do is just dollar cost average in. I think right now it's just a great price, and it's very likely to come down. It could just go back up. Who knows? But if you're just dollar cost averaging in every week, every other week or so, it doesn't matter what that price is, as long as you're staying pretty reasonable, keeping it under that 320, 330 mark, I think you'll be fine. So that wraps up our discussion today of Microsoft, quite possibly one of the best businesses in the world today. And currently they are on a nice little fire sale. They are, along with a lot of other tech stocks right now in the industry. However, let me know what you think. Do any of you own Microsoft right now? Do you think that my valuation is way off? Please let me know by commenting below. Please, if you have not already, hit that like button, and please subscribe to the channel. It really helps us out and lets me know you want to be a part of our community of quality investors. Happy investing, everyone.